and welcome to the Business Standard Morning Show. I'm Nazia Iqbal, and here's a look at the stories for the day. The United Nations Intergovernmental Panel on Climate Change, or IPCC, has issued its final warning. Climate efforts by nations are not enough to limit global warming to 1.5 degrees Celsius above pre-industrial levels, and it is becoming harder to contain the average temperature rise below 2 degrees Celsius. What are the implications of this warning, and is there a way forward? Bhashwar Kumar brings you the answers.
The world must brace itself for continued temperature rise, compound heat waves, droughts, and sea level rise. Why? Because the IPCC's latest synthesis report has warned that there is hardly any scientific scenario in which the world can avoid such calamities across regions during this decade. Here's the gist of the latest IPCC report. Across the world, while policies and laws meant to reduce or prevent the emission of greenhouse gases have consistently expanded, gaps and challenges remain. The report has warned that even with the nationally determined contributions announced by October 2021, the global greenhouse gas emissions expected in 2030 make it likely that warming will exceed 1.5 degrees Celsius during the 21st century and make it harder to limit warming below 2 degrees Celsius. Against this backdrop, Business Standard spoke to experts to find out what they think about the report and its warning.
So the report is quite clear that compared to the previous assessment, which was 7 or so years ago, we are likely to see impacts at lower temperatures than we earlier thought. So 2 degrees and 1.5 degrees are political shorthands. These were the numbers embedded in the Paris Agreement. But in practice, what it says is try and limit warming as much as you possibly can. It shouldn't be read to mean that if we go to just to 1.55 degrees, things suddenly fall off a cliff face. No, but it's also not the case that it's smooth. It just means that we will see more impacts the higher the temperatures.
The maximum temperature rise beyond which impacts will become truly catastrophic is 1.5 degrees Celsius above pre-industrial levels. Current emission levels, meaning the levels at which we are emitting greenhouse gases on an annual basis, will lead to us blowing past that 1.5 degrees Celsius threshold within this century, unless we make efforts to rapidly reduce the output of emissions that we are putting right now.
The warning isn't new. The United Nations Emissions Gap Report, released in October 2022, said that even the updated climate pledges by countries, including India, would lead to a less than 10% cut in projected 2030 greenhouse gas emissions. A 45% reduction was necessary by 2030 to limit global temperature rise to 1.5 degrees Celsius by the end of the century. But this could be one of the last warnings we get. Released on March 28th, the current synthesis report is the final summary under the 6th assessment cycle of the IPCC, which is also its last since its inception in 1988. On the same day that the synthesis report was released, Indian scientists who were part of the IPCC said that India was among the countries that faced the highest risk from the impact of climate change, ranging from heat waves to cyclones and urban and rural displacement. The economic impact is already visible. Heat waves cost India an income loss of 5.4% of gross domestic product in 2021. The Climate Transparency Report said that this was the highest such loss among G20 nations. Against this backdrop, what are the major stumbling blocks and possible solutions? The latest synthesis report said that while global climate finance had shown an upward trend since the 5th assessment report, current flows, both public and private, for adaptation were insufficient. This was hampering the implementation of adaptation options, especially in developing countries. The report also underlined the gap in funding to developing and poor nations for their energy transition and climate adaptation plans. To meet the Paris Agreement's 1.5 degrees Celsius goal, total climate finance must grow more than 10 times faster than current rates. Instead, the rate of increase has slowed in recent years. Total climate finance must reach $5.2 trillion per year by 2030, according to the World Resources Institute. This will mean an average increase of $460 billion a year.
While we may feel there's a strong case, and there is a strong case for the West in the sense to front the cost of this transition, they find it very hard to actually extract that money from within their political systems at a scale that are needed for countries as big as India, China, South Africa, Brazil, and so on. And so the question becomes, can you then attract private capital? But the challenge there becomes that a lot of the investments in places like India might be a bit more risky. But the somewhat good news is climate finance is not some little marginal conversation anymore. It's very much at the mainstream of discussions around global finance, around reform of the multilateral development banks.
Pointing at solutions, the IPCC laid emphasis on climate resilient development. To enable this and adaptation and ambitious mitigation plans, its prescription includes prioritizing equity, climate justice, social justice, inclusion, and just energy transition processes. The panel also called for enhancing adaptation outcomes by increasing support to the most vulnerable regions and for accelerating climate action by integrating it with macroeconomic policies.
When we make choices about infrastructure, we should be thinking about building it in a way that is resilient, for example, to coastal storms. When we think about our agricultural systems, we should be thinking about policies that support agriculture that are more resilient to climate variation. When we think about our energy systems, certainly we should be trying to lock in low carbon rather than going down the path of high carbon systems that are harder to unwind later. So it says, start thinking about climate change in the context of mainstream development decisions.
The good news is that the IPCC also provides a whole menu of options or solutions to address this crisis. The IPCC, for example, is quite specific. It points out that regulatory instruments such as emission standards, for example, which are driven by governments, can actually support deep emission reductions. Carbon pricing instruments, on the other hand, such as cap and trade systems, which are market-based instruments, tend to be less effective in emission reduction.
Clearly, the time for warnings and reports has passed. Action is the need of the hour. And as a first step, the global financial system must be aligned with the 1.5 degrees Celsius goal.
From global warming, we now talk about another alarming climate issue, the blistering summer that India is likely to face. This summer is most likely going to be a hot one. Not to mention February was the hottest since 1901. This will put a strain on the country's resources. Grain output, particularly wheat, which is in its procurement season, will be a key aspect. There will also be a spike in power demand, so is India ready for an extreme summer? Here's Tushar Verma's report.
Parts of India will have to deal with above normal summer temperatures till at least May this year. Northeast, eastern and central regions will be most affected. Recently, the India Meteorological Department or IMD had come out with a report saying that maximum temperatures in parts of India would increase by 2 to 3 degrees Celsius for a few days. So, how warm will this summer turn out to be?
We are not expecting any significant heat wave conditions in the month of March. As far as season is concerned, we also issued a seasonal forecast for the season March to May. There we told that yes, temperature will be higher over central part of the country and adjoining northern parts also. And accordingly, we predicted heat wave conditions mainly over central India, starting with South Rajasthan, Gujarat, northern parts of Maharashtra, Madhya Pradesh, Chhattisgarh, Odisha, Telangana, northern parts of Andhra Pradesh, and Ganjati, West Bengal, Bihar, Jharkhand, and East UP. In the month of April and May, we may have the higher than normal heat wave conditions. over this period.
The forecast of a long and dry summer will affect water reserves, grain storage, and power demand in the country. Water levels in the reservoirs are less than the corresponding period of last year. As of March 16, the combined water reserves were 46% of the live storage capacity. During the same period last year, water reserves were 50% of the live storage capacity. This year, the rainfall so far has not been adequate either. During January-February, the rainfall was 45% less than normal. More worrisome is the fact that in February 2023, monthly average maximum temperature in India was highest since 1901. High temperatures can take a toll on wheat output. The March to May period is when wheat procurement across the country's northern belt, Punjab, Haryana, Madhya Pradesh, Rajasthan, Gujarat, and western Uttar Pradesh is at its peak. With exposure to excess heat, the wheat lying in the open deteriorates in quality. So, how well is India prepared to deal with unusual summer temperatures?
See, heat waves, we have been prepared. We means our governments, both the central as well as state governments, have been preparing the heat wave action plans for many years now. Most of the states have their own heat wave action plans. Once IMD issues a warning, they have some standard operating procedures, SOPs and protocols, etc., how to handle it. And they have been doing very well, frankly speaking. They have been doing very well. And for example, the people who are dying due to heat waves, if you really see last 4, 5, 6 years, it is decreasing. But heat wave doesn't affect only the human health. It has an effect on agriculture, for example. And my understanding is that wheat crops have been affected so far. So it's a good news.
Households are set to crank up air conditioning to deal with the hot summer. This, in turn, will impact power demand in the country. Coal India had a target of supplying 590 million tons of coal in 2023-24. However, this was later revised to 610 million tons in lieu of increasing power demand. Last summer, many parts in India faced blackouts due to inadequate coal supply. So, how will the spike in temperatures this year impact power demand?
The demand, if you see in January, the demand grew by almost like 18% and in February by 10%, right, compared to the previous year. Usually, historically, if you see, the demand has grown by 4.5% or 5%. But this summers itself, we are seeing somewhere around more than 10%, 15%. So that's the kind of growth and demand we are seeing, whereas vis-a-vis the supply hasn't been growing that much.
Prime Minister Narendra Modi had recently called for optimal grain storage, fire audits, and mock drills in hospitals as preparations for the harsh summer forecast by the IMD. He had also asked officials to track the water levels in reservoirs. However, how things will pan out will depend on the trajectory of the summer heat.
Prices of gold have jumped 8% in less than 2 weeks as investors looked for cover in a volatile environment. Recessionary fears further inflated the price of the yellow metal to lifetime highs of 60,000 rupees per 10 gram earlier this week. However, as the US Federal Reserve grapples with a banking crisis amid sticky inflation, where will gold prices head in the near term? Here's a report.
The price of 10 grams of gold surged past 60,000 rupees for the first time this week as the global banking crisis gripped the markets. While prices fell in the early part of 2023 on expectations that the US Fed will cut rates aggressively to tame inflation, a string of bank collapses over the past few weeks has increased recessionary calls. These fears prompted investors to park their money in safe haven assets like gold, pushing the precious metals prices by around 8% higher over the past fortnight. The bullion has also outperformed equities so far in FY23, surging 14% against negative returns by benchmark indices. In the times to come, analysts believe the US Fed's interest rate decision may move the prices of gold in either direction.
The gold prices have definitely crossed 6% so far, but the percentage increase will be much higher this year, as we are seeing strong inputs and data which are going to take the gold prices even higher. Now in COMEX we have already seen that levels of 2000 being tested right now currently, and going ahead the next hurdle is 2150, 2100. So comparatively we are going to see the prices of around 62,000, 62,500 easily onto the MCX prices, as also the rupee is also depreciating and in a range where the crude prices are only helping the rupee to not fall further, but beyond that the FIS selling is definitely helping the rupee prices to to be on the weaker side. So this is also again going to help the gold prices, and the levels which are going to be quite achievable, which looks around 62,000 to 63,000 into the MCX and 2100 2150 onto the COMEX prices.
On the flip side, the US Fed's steadfast stance to keep increasing interest rates to bring inflation within comfortable limits may halt the steep rally.
Despite UBS agreeing to buy the beleaguered Credit Suisse and the US Federal Reserve opening dollar swap lines with other major central banks, banking concerns continue to linger. Thus, gold is seeing strong buying momentum. Credit concerns continue to linger as Credit Suisse AT1 bonds worth $18 billion are being wiped out during the US takeover process. Investors continue to fret over the health of the banking system. US 2-year yields have tumbled nearly 150 basis points from the peak in March. Both gold and bonds may fall if the Fed stays on its course of rate hikes. Gold is expected to be extremely volatile. A run to $2025 is possible, but sustainability of this sharp rally is doubtful. If no more bad news and Fed hike is hawkish, gold may fall to $1940 or $1900, as present crisis is more about poor risk management, confidence and liquidity rather than being a systematic threat to the entire banking system.
While there may be some steam left in gold's rally, the medium-term outlook will depend on how the US Fed manages the banking crisis and liquidity in the system. As regards today, the US Fed's interest rate decision and treasury yield movements will guide equity trading.
Treasury bills or T-bills are short-term debt instruments issued by the center in 3 tenors, that is 91 days, 182 days and 364 days. In the last 6 weeks, the 364-day T-bill yield has risen by 58 basis points amid high uncertainty over interest rate hikes and worsening liquidity in the banking system. On Wednesday, the 365-day T-bill yield in India rose above the benchmark 10-year bond, signaling a yield curve inversion. The Reserve Bank of India sold 364-day notes at a 7.48% yield, the highest since October 2018. So what are T-bills and what does inversion of yield mean? Raghav Agarwal decodes it for you. On Wednesday, the 365-day Treasury bill yield in India rose above the benchmark 10-year bond, signaling a yield curve inversion. The Reserve Bank of India sold 364-day notes at a 7.48% yield, the highest since October 2018. In the last 6 weeks, the 364-day T-bill yield has risen by 58 basis points amid high uncertainty over interest rate hikes and worsening liquidity in the banking system. But what does this mean? Let us decode. First, let us understand what T-bills are. These are short-term debt instruments issued by the center and are presently issued in 3 tenors, namely 91 days, 182 days and 364 days. T-bills were first issued in India in 1917. They are issued via auctions conducted by the RBI at regular intervals. Individuals, trusts, institutions and banks can purchase T-bills, but they are usually held by financial institutions. These are issued when the government needs money for a short period. These can only be issued by the Government of India and the interest on them is determined by market forces. The yield curve shows the returns on government securities for various tenures. Generally, the curve slopes upwards and the returns increase with a longer maturity period. But when the returns on these securities in the short term are higher than in the long run, the curve starts to slope downwards. It is called yield curve inversion. The term inverted yield curve was coined by the Canadian economist Campbell Harvey in his 1986 PhD thesis at Duke University. Yield curve inversion suggests that the market is becoming more pessimistic about the economic prospects for the near future.
I will achieve, I will fly high. I am the SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
According to the World Economic Forum, inverted yield curves have signaled recession successfully almost every time. They have preceded every recession since 1956 except once in 1966. Well, that's all we have for you today. For more news and analysis, please log on to business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.